So with this lecture we're going to start moving away from the unincorporated businesses to look at incorporated, i.e. companies. So first of all, this introductory lecture is going to look at the capital structure and finance costs. So by the end of it you should be able to understand the capital structure of a limited liability company, record the movements in the share capital and share premium accounts, define and discuss and record bonus issues and rights issues of shares, and also to record dividends and finance costs in the ledger accounts. Chapter 28 from your Thomas & Ward textbook accompanies this. So, distinctive features of limited companies. The main differences between sole trader and a limited company. A limited company is a separate legal entity and distinct from its owners. This is in contrast to the sole trader, who is in law not a separate entity from the business, even though is treated as such for the purposes of accounting. The key advantage of this is the limited liability that the investment in shares offers the shareholder. While sole trader has unlimited liability for the debts of his business, shareholders have limited liability for the debts of the company in which they hold shares. So there are two types of limited company, a private limited company and a public limited company. A public limited company must include in its name the letters PLC, standing for Public Limited Company. Private limited companies must include Limited or LTD in their name. Main difference is that a private limited company may not offer its shares to the public, and so all companies listed on the stock exchange are therefore public companies. So looking at the advantages and disadvantages of incorporated status. So the advantages: if the company goes into liquidation, the owner of the company, i.e. the shareholders, are only liable to pay any amounts that have not yet been paid for the shares that they hold. A sole trader would be personally liable for any outstanding debts of the business. The shareholders can share in the profits of the business without necessarily having to work day to day for the business. Companies generally are in a better position when borrowing money, so they can issue something which is called, for example, debentures, loan stock, bonds. A company will continue in existence even if shareholders die. If a sole trader dies, the business will only continue if the business is sold, and this is what's known as perpetual succession. The disadvantages are a large company, so one that meets certain size criteria, must normally have an audit of its accounts and therefore pay auditors' fees. However, an audit also offers benefits to the company. A company must prepare its accounts in the format prescribed by legislation. A company suffers a greater administrative burden than a sole trader. For example, it must file its accounts each year with the Registrar of Companies and must hold an annual general meeting of its shareholders. So the accounting distinctions between limited company and sole traders: three main differences: the way in which the profit and the tax are dealt with in the statement of profit or loss, the composition of the capital in the statement of financial position, and the statutory requirements of the Companies Act 2006. The accounts prepared by a company for its own internal use can be in any format that the managers choose. It's only the accounts that are filed publicly with the Registrar of Companies each year that have to follow the statutory formats, and the formats will be looked at in the next series. The capital structure of a limited liability company. All companies have to be financed regardless of the type of company that they are. Without financing of any sort, the business would not be able to begin trading. They would not be able to purchase raw materials, recruit staff, advertise products, or even put fuel in their vehicles. Finance is provided by the capital invested in the business. Capital is something that on its own has little or no use, but it can be employed in the generation of wealth. Money is a form of financial capital, and it can be used to exchange for goods and services, which then can be put to good use within the business. So the main splits of capital within a company: so debt. So the holders of debt are entitled to some form of mandatory repayment, e.g. interest, and eventually the repayment of the amount that was lent. Equity, share capital. So shareholders or equity holders are not entitled to any repayment. Instead, they share the residual assets, so assets minus liabilities, of the business when it ceases to trade. There are a number of ways that a business can attract financial capital, but each has its own characteristics and consequences. In general, all forms of finance can be loosely categorised into two distinct groups: debt, which requires some form of monetary transfer of economic benefit to the provider of the finance, or equity, which gives the provider of finance the rights to share in the residual assets of the business when it ceases to trade. Most forms of finance are simple to categorise, but some forms of finance have characteristics of both debt and equity, and it's not entirely clear whether they are debt, equity, or both. For this syllabus, for this module, you'll need to be aware of three forms of financial capital and how to record them in the financial statements. So the first one being ordinary or equity share capital. So this is the equity as the directors are under no obligation to repay the investors, the shareholders, or even to pay them a dividend. The second type is loan notes. Under the terms of a loan note agreement, directors are usually required to pay the loan holder an annual interest amount and are also obliged usually to repay the full debt at a fixed time in the future. The final type is preference shares, so these can be either classed as debt or equity depending on their terms. If there's an obligation to repay the preference shareholder, i.e. they're redeemable, then this is evidence of a debt and shown as a liability. If they're irredeemable preference shares, then they do not have to be repaid and they are classed as equity. So looking at ordinary share capital then. So share capital represents the capital invested in the company by its shareholders by the purchase of shares. The reserves of a company represents the balance of the net assets belonging to the shareholders. These may include part of the past issue of share capital known as share premium, retained trading profits that have not yet been paid out as dividends, any kind of revaluation gains when the non-current assets have been revalued. Ordinary share capital is treated as equity and the associate dividend payments are recorded in a statement called the Statement of Changes in Equity. They are not an expense of the business. Each share has a nominal or par value, often £1, 50p, 25p. However, this is arbitrary and is assigned to a share when it is actually issued. This nominal value remains fixed, whereas the market value will actually fluctuate over time, and this nominal value, is often used as a means for calculating the dividends paid to shareholders, usually as a fixed percentage on the face value. Shares are sold in the first instance by a company at an issue price, and this should be at least equal to the nominal value of the share, but often it will exceed it. Once shares have been sold to the public, the shareholders may then sell their shares privately. The value at which the shares are trading on the open market is usually referred to as the market value. And the market value of the share fluctuates according to the success or the perceived expectations of a company. If a company is listed on the stock exchange, the value will be determined by reference to recent transactions between buyers and sellers of shares. This value does not feature anywhere in the financial statements. So, accounting for the issue of ordinary shares, equity shares. So if a company were to issue shares at their nominal value, their face value, the double entry to record this raising of finance would be to debit the cash with the issue price times the number of shares, and credit the share capital account with the nominal value times the number of shares. In reality though, companies generally issue shares at a price above their nominal value, above their face value, and this is referred to issuing shares at a premium. So the double entry to record such an issue would be to debit the cash with the issue price times the number of shares, credit the share capital with the nominal value, the face value times the number of shares, and credit the share premium with the balancing figure, i.e. the difference between the issue price and the nominal value times the number of shares sold. Both the share capital and the share premium accounts are shown on the statement of financial position within the equity section. So let's have a look at a short quick example. So Bourbon issued 200,000 25p shares at a price of £1.75 each, and we've got to show these transaction in the ledger accounts. So we have a 200,000 shares and they have a 25p nominal value, and they've been issued at £1.75 each. So of that £1.75, we have 25p will be to the share capital account per share, and the remaining £1.50 will go to the share premium account as being the premium above the nominal value or the face value. So in terms of our cash then, so cash received in terms of share capital, share premium will be 200,000 shares were issued at £1.75, generating £350,000. And so the opposite entries, so share capital from the cash account, so that will be 200,000 shares at the face value of 25p. So that's going to give me 50,000 credit into the share capital account, and then the remainder would go into the share premium account, so 200,000 shares times £1.50, and so that would mean that 300,000 would be recorded in the share premium account. And this is how we record these shares that were issued at above a nominal value. So we also have a type of issue called a rights issue. And so a rights issue is the offer of new shares to existing shareholders in direct proportion to their existing shareholding at a stated price, which is normally below the market values. Otherwise, how are you going to entice your existing shareholders to buy more shares from you? So the advantages are, a rights issue is the cheapest way for a company to raise finance through the issuing of further shares. A rights issue to existing shareholders has a greater chance of success compared with a share issue to the public. The disadvantages are that a rights issue is generally more expensive than issuing debt, and it might not be successful in raising the finance required, as not all of the shareholders might take up the rights and purchase these additional shares. So a rights issue is accounted for in exactly the same way as a normal share issue, and therefore have exactly the same impact on the financial statements as an issue at full price. So let's have a look at a short example dealing with a rights issue. So upon incorporation in 2016, the Jammy Dodger, a limited liability company, issues 1,050p shares at nominal value, so at face value. Needing further funds in 2017, makes a rights issue of a 1 for 5 at 75p. This offer is fully taken up, which means all of the existing shareholders will all buy their additional 1 share based on the 5 that they currently hold. So we've got to firstly draw up the accounting entries for these 2 years, and secondly have a look to see what it will look like in the equity section of the statement of financial position. So first of all then, our accounting entries. So for 2016, so this is going to be a initial offering. So we're going to debit the cash account with the cash received, and we've got 1,050p shares, so it's going to be raising £500, and we're going to credit share capital with the full amount of 500. because these shares were issued at their face value, their nominal value. There was no share premium in this particular instance. So then in 2017 we have got a rights issue. So the rights issue, on the basis of 1 for 5 that are currently held. So this means that for every share that for every 5 shares that a shareholder currently has, they'll be entitled to buy another one. So in terms of the number of new shares, so there's currently 1,000 shares in issue. For every 5 that a shareholder has, they can buy another one, and so this means that we're going to have 200 new shares issued by the company. So again, looking at the double entry then, so we're going to debit cash with 200 shares times 75p. So that's going to bring in an extra £150. And then we're going to credit the share capital. So 200 shares times the nominal value of 50p. So we're going to have £100 into share capital. And then the balancing figure will go to the share premium. So 200 shares times 25p, so that means the £50 will go into the share premium account. So what will that look like then in terms of the statement of financial position? So in an equity section, so similar to the capital section on a sole trader set of accounts. So we're going to have share capital, and we've got 50p ordinary shares. So we have the 500 from the original issue, the £100 from the rights issue, so we've got 600 sitting in the share capital account, and then in the share premium account we're going to have the balance from the rights issue, so the other £50 will sit in there. And so that's how our statement of financial position equity or capital section will look in 2017 after this rights issue has taken place. So another type of share issue that we could have would be a bonus issue. So bonus issue is where we offer new shares to existing shareholders in the proportion to their existing shareholding, exactly the same way as a rights issue. However, in this instance, no cash is actually received from the bonus issue. So the advantages are issued share capital is divided into a larger number of shares, making the market value of each one slightly less, and so hopefully more marketable, more people will want to buy them, and hopefully it will end up actually bringing the price up in the near future on the market. The issued share capital is brought more in line with the assets employed in the company by reducing stated reserves and increasing the share capital. Disadvantages: there are still administrative costs that are necessary to be met in order to make or issue the shares under a bonus issue. So as no cash is received from the bonus issue, the issue must be funded from the reserves of the company. Any reserve can be used, though a non-distributable reserve, such as a share premium account, would normally be used in preference to those that can be distributed, and we'll look at the difference between distributed and non-distributed reserves in due course. So where we have a bonus issue then, so we're going to debit a non-distributable reserve, normally share premium. with the nominal value of the shares that are issued, and credit the share capital account with the nominal value of the shares issued. So if we have a look at the short question below, dealing with Gingernet Limited. So it's a limited company and has 20,000 50p shares in issue. Each were issued for £1.25, and they make a 1-for-4 bonus issue, capitalising the share premium account. So we have got to draw up these transactions for the initial issue and the bonus issue, and then draw up a statement of financial position extract of the equity section. So first of all then, dealing with the original issue, we're going to debit cash with the cash coming in, and we've got 20,000 shares at £1.25. So we're going to receive £25,000, and then we're going to credit share capital with the nominal value of these 20,000 shares. So 20,000 shares at 50p. So we're going to have 10,000 credited to share capital, and then we're going to credit share premium with the balance. So 20,000 shares issued at 75p. So we're going to have 15,000 in the share premium. So then for the bonus issue, so first of all we need to establish how many new shares. So we have a bonus issue on the basis of 1-for-4. So we have 20,000 shares currently in issued. For every 4 shares in issue, you can be given another 1. So there's going to be 5,000 new shares issued. So it says that we are to utilise or capitalise the share premium account, so we're going to take money or the value out of the share premium. So we're going to debit share premium with the 5,000 shares at nominal value, so at 50p value. So we're going to transfer 2,500, and we're going to credit share capital to reflect these new shares being issued at nominal value of 2,500. So now looking at the equity section, so we have share capital. So we originally had £10,000 from the original issue, plus the 2,500 from the bonus issue. So we have 12,500. And then in the share premium account, we originally had 15,000, and we've transferred 2,500 out, so we have 12,500 in the share premium account. So looking at dividends then, so dividends represent the distribution of profits back to the shareholders. They're usually expressed as an amount per share, so either 10p per share or 10% of nominal value. Dividends on preference shares are usually based on a predetermined amount, such as 5% of the nominal value. In terms of ordinary dividends, so a company may pay a mid-year or interim dividend, and then the double entry will be to debit the retained earnings, i.e. reduce the retained earnings and disclosed on a statement of changes in equity, and credit the bank to represent the money being paid out of the company's bank account. At the end of the year, companies may propose or declare a dividend to the ordinary shareholders, i.e. tell them that a dividend is going to be paid after the year end. This is a final dividend. These dividends have to be approved at the annual general meeting, and until this point the company has no obligation to pay them. So therefore, proposed dividends at the year end that have not been approved by the shareholders cannot be recorded as a liability at the year end. So another type of financing that a company could have would be loan notes or loan stock, bonds, debentures, all mean the same sort of thing. A limited company can raise the funds by issuing these loan notes. These generally are fixed term, in which case they're dated. The term loan note simply refers to the document that is evidence of the debt, often a certificate that is issued to the lender. Similar to shares, the loan note will have a set nominal value, e.g. £100. Individuals or organisations can buy the loan notes at an agreed price. This can be any value, it doesn't have to be the same as the nominal value. The life of the loan note will be fixed, and the company issuing them will have to pay the loan note holder back at an agreed point of time. The issuer will also have to pay interest to the loan note holder. The interest will be calculated based on the nominal value of the loan note, so 5% of nominal value, for example. The interest incurred is included in the finance costs of the statement of profit or loss. So in terms of our accounting entries, so when a finance is first received, the company receiving the finance must recognise the obligation to repay the loan holder as follows. So debit the cash to receive the money into the bank account, and credit a non-current liability as the loans genuinely are for more than 1 year. Every year the business should recognise a finance charge, i.e. the interest, based upon the terms of the agreement. So we'll debit the finance charges expense in the statement of profit or loss, and credit either cash or current liabilities, depending on whether the actual interest has been paid or not at the year end. So looking at an example, so we have Custard Creameries is an incorporated business, and it needs to raise funds to purchase plant and machinery. On the 1st of March 2017, it's issuing £150,000 worth of 10% loan notes, which are going to be redeemable in 10 years' time. In other words, we're going to borrow the money now, £150,000, we're going to be then paying interest at 10% of that, and then in 10 years' time we're going to return the £150,000 back to the borrowers. Interest is paid half yearly at the end of August and February. So we need to draw up the accounting entries for the year ending 31st December 2017, and to also show the extracts on the statement of financial position. So on the 1st of March then, when the actual issue is made, we're going to debit the cash with the £150,000 received, and we're going to credit a non-current liability for 10% loan notes for £150,000. So this recognises that we have a liability that's going to be repaid in more than 10 years' time. Then on the 31st of August, when we've got the first payment of our interest, we're going to debit finance cost expense on the statement of profit and loss with the interest. So we've got £150,000 worth of loan notes, and the interest is going to be at 10%, and it's just going to be for half of the interest charge for the year. So we're actually going to charge £7,500 worth of interest, and it's going to be coming out of the bank account, so we're going to credit cash or bank with the £7,500. So the other payment is not going to be made until February. However, we're going to draw up a year-end position in terms of December, so we need to accrue for that interest charge. So the 31st of December, we've got September, October, November and December, so we've got 4 months of interest to accrue for. So we are going to debit the finance cost on the statement of profit and loss with £150,000 worth of debt at 10% and 4 months worth of interest. So this will result in a charge of an additional £5,000 up to the year end, and we're going to credit a current liability for interest payable of £5,000. So now, in terms of the statement of financial position, so in terms of our entries, we're going to have some non-current liabilities. So this is the loan note outstanding, so we're going to have our 10% loan note of £150,000. In terms of the current liabilities, we're going to have interest payable of £5,000, the amount that hasn't yet been paid at the year end. And then on the statement of profit or loss, included in finance costs, we're going to have the £7,500 that was paid during the year and the £5,000 that's payable by the end of the year. So we're going to have £12,500 recorded as our finance costs. So the last type of capital is our preference shares. So preference shares are shares carrying a fixed rate of dividend, the holders of which have a prior claim to any company profits that are available for distribution, which means that they will be paid their dividend in preference to the ordinary shareholders. If preference shares are redeemable, they're treated the same as loan notes and recorded as a liability in the statement of financial position, and dividend payments are treated the same as finance charges. If the preference shares are irredeemable, then shareholding and the associated dividends will be treated in exactly the same way as ordinary shareholders. So they will be shown in the equity section, and the dividends will not go through the profit and loss. They'll go through the further statement of changes in equity. So having a look at a short example dealing with Cracker Limited. So Cracker has the following share capital. So we have ordinary 50p shares, £200,000 worth. We have some 8% irredeemable preference shares of 50,000. So irredeemable, so that means undated. And so it's going to be treated exactly the same way as ordinary share capital or equity share capital. So company pays an interim dividend, so a part year declaration of 12.5p to its ordinary shareholders. pays the preference shareholders their dividend. Before the year end, the company proposes a final dividend of 36.5p per share to its ordinary shareholders. So we're going to calculate the amount shown in the financial statements relating to those dividends for the year. So in terms of the ordinary share capital, so the number of shares will be £200,000 divided by 50p. So that will tell us that there are 400,000 shares in issue. So that should be correct. So £200,000. For every pound of share capital, there are 2 shares in issue because there's 50p each. So you could do 200,000 times 2 to get the 400,000 shares. However, it's probably easier to get it correct if you actually divide it by the actual face value of the shares. So in terms of my interim dividend, so I'm going to be paying 12.5p per share, and there are 400,000 shares in issue, and so that means that I'm going to be paying £50,000 worth of dividends. So in terms of the final dividend, well, this doesn't actually get recorded through the financial statements because it's still proposed. Remember from earlier, it has to be voted on at the annual general meeting, which will take place after the year end, and so at the year end there is no obligation to pay this dividend, there is no liability. And then we have the preference dividends. So in terms of the preference dividends, we have £50,000 worth of preference shares, and we're going to be paying 8% in terms of our dividend payment. So we're going to be paying £4,000 worth of preference dividends. So in terms of the dividends that are going to go through the accounts, we're going to charge a £50,000 interim dividend on the ordinary shares and £4,000 on the preference shares. And so when we actually have a look at the financial statements of a limited company, we'll actually look at how that is presented in the financial statements. So the final type of entry that we have in the equity section of the statement of financial position are the reserves. So the non-current assets and current assets are shown on the top half of the statement of financial position. The non-current liabilities, the current liabilities, together with the equity and reserves are shown on the bottom half. So the equity and the reserves, they will comprise of share capital, retained earnings, any capital reserves such as the share premium, and all of the equity and reserves effectively is owed back to the owners, i.e. the shareholders of the company. In terms of revenue reserves, the most common ones will include the retained profits or retained earnings, perhaps a general reserve, and any other reserves that are set up by the directors and designated for a specific purpose. So it could be, for example, restructuring reserves, it might be a relocation reserve, it could be a redundancy reserve. We then also have retained earnings. So these will comprise of the cumulative total of the company's retained profits, In respect of each accounting period, the profits attributable to the equity shareholders will be added to the retained earnings. And when a dividend is paid to the equity shareholders, this is deducted from those retained earnings. The capital reserves, these cannot be legally paid to equity shareholders as a dividend. In other words, they are designated as undistributable. Common capital reserves will include share premium account and could also include a revaluation reserve. So every time we adjust upwards or downwards in certain circumstances the value of our non-current assets. So we'll look at some more questions in class this week, and then later on in your second session we'll be moving on to look at company financial statements as recorded under International Accounting Standard number 1.